So we are going to be recording today's session as well. So firstly, I just wanted to say a really big welcome to everybody for joining us, all of our MGI Worldwide and CPAAI member firms. Also great to see some member firm clients joining us as well. Hello to you. We've had, I just checked the numbers, we had over 100 register for today's webinar from 30 countries. So it just goes to show and remind us all of, you know, what a great international network and diverse range of professionals we have as part of us as well, joining us today. So I'm going to hand over very shortly to Paul Winder, who's going to introduce Robert and Michael so we can get started with today's webinar. We are recording it. Please use the chat for posting any questions that you may have, and Robert and Michael will address those at the end of today's session. I think that's everything for me. I'm going to hand over to you, Paul.
Thanks, Maxine. Well, I'm delighted to introduce this afternoon's webinar. Everything you need to know about you and your clients doing business in the USA. A number of firms I know in the UK and Ireland have dealt with Robert Hoberman of Hoberman Lesser, and they've always received excellent service, and I've never heard anything but great things. So I do want to put that really positive message out there to start with. But Robert, if you don't know Robert Hoberman, he's the managing partner of Hoberman Lesser, a key MGI Worldwide contact. He's been with the firm, heaven forbid, 30 years now. 40 years, sorry, got my numbers wrong. But he's over 30 years experience in management and consulting of all types of business. His range of expertise goes from structuring business deals, tax planning, estate and gift planning, valuations, including the use of trusts. And he's got extensive familiarity dealing with banks and financial institutions, as well as tremendous knowledge of data processing, systems analysis, and consulting for commercial applications. This afternoon is going to be structured with two presentations. Robert's going to kick off in a moment, and then we're going to have Michael Einbinder from Einbinder and Dunn, who will give you a legal perspective of doing business in the US. If you have any questions, do pop them in the chat box, because we'd really like to answer some of the specifics that you'd like to know about doing business in the US, albeit I think an awful lot of what you want to know will be covered by these gentlemen this afternoon. So without further ado, I'd like to hand over to Robert to take us through doing business in the US from an accounting perspective.
Thanks, Paul. I'm going to share my screen right now, so hopefully that comes up. Everyone can see that. Does that show up now?
Yeah, looks great.
Okay, good. Excellent. So again, my name is Robert Hoberman, the New York member of MGI. I want to thank everybody for joining us today. I apologize in advance. We're using the translation services from PowerPoint just in case anything translates that is offensive or embarrassing. It's out of my control. We're trying this for the first time, and hopefully the translation will work and be accurate. I'm going to cover a lot of things today. I'm trying not to go into any one of them in great detail. Some of the topics I'm going to go through very quickly because they're just too complicated and probably beyond the scope of getting the things done in this very short time frame that we have. So let's start off with the different forms of doing business in the US. Most foreign entities will choose either a corporate form or an LLC, a limited liability company. There are other choices. They're much more rarely used: partnerships, trusts, and S corporations. S corporations are a regular corporation that makes a particular tax election in the US. But when most foreign entities do business in the US, most of them choose to create a corporation or an LLC, and typically when they choose an LLC, they elect to have that LLC taxed like a corporation. So there's a little bit of nuanced differences between those two things. It's dictated at the state level And I'm going to go into some of those things, and Michael may cover it a bit more than I do. In the US, all entities are formed at the state level. We have 50 states in the US. There is no such thing as creating a federal corporation. States are created under the auspices of the individual states' rights. Different states have different legal rights for shareholders and different corporate obligations, as well as different tax structures. So we take that all into account. Two of the most popular states for shareholder and for corporate rights would be Delaware and Nevada. Typically, the corporation is 100% owned by the foreign entity. It doesn't need to be 100% owned. It could be partially owned. You could form a corporation, own a percentage of it, and have a partner that owns the other part of it. In the US, the corporation pays the taxes on its income. There's no flow through of the income to the owner. And then after the corporation accumulates its income, typically it pays dividends to the shareholders. Dividends paid are taxed as ordinary income. And when you have a foreign shareholder, there is usually withholding depending upon the treaty with the US. Different countries have different treaty provisions. However, typically when you pay the tax in the US, you get a corresponding credit in your home country for paying the tax, so that you don't wind up paying a double tax. One of the unique things to US law is a dividend paid in liquidation, when you terminate the corporation and liquidate it, is usually tax-free to the recipient. So there are dividends paid on an annual basis for distributing the earnings, and then dividends paid at the end on a liquidation. And the liquidating dividends have that benefit of usually being tax-free. I just want to make sure I didn't miss anything. Okay. In LLC, LLCs can have only one member, or they can have multiple members. And there's a little bit of a difference here. LLCs with only one member that don't elect to be taxed as a corporation. So if they're one member LLC, then for tax purposes in the US, they don't exist. For legal purposes, liability purposes, they do. But then all the income flows through to the owner of the LLC. The reason why most foreign entities choose to be taxed as a corporation is that they want to keep their own home corporation or their own personal affairs out of the reach of the US. So if you're an LLC with one member or multiple members and you don't make the election, then the owners pay tax on the income. The election to be taxed as a corporation has to be made within 75 days of the start of the tax year. So if you form a corporation on June 1st, you have 75 days to make that election. If the corporate year end is December, you have, again, the clock starts again for the next year. So you have 75 days from January 1st to make the election. Partnerships are rarely used in foreign transaction, but in a partnership, the partnership pays no tax in the US, and the income flows through to the individual members that own the partnership interest. And if you have a foreign partner, the partnership's required to withhold tax on any distributions. Additionally, you can do business from your home country using your existing corporation. It's called a branch of a foreign corporation. You don't need to set up a corporation in the US. And if you're doing relatively little business for a short period of time, then this may be the simplest and best way to do things. However, if the foreign entity, if your foreign corporation or your foreign entity, whether it's an LLC or an individual, is effectively connected to the US, and that means you have a permanent establishment, either an office, a warehouse, some type of place where either you're paying rent or you do your business out of, or you have employees in the US for more than 180 days, then your business is effectively connected to the US. And then the foreign entity has to file a tax return in the US and pay taxes on its US income. Additionally, if the effectively connected income is greater than 25% of the foreign corporation's gross income, then when the foreign corporation pays dividends to a US non-resident, it will be subject to withholding. And there's a thing called a branch profits tax of 30% that could be eliminated by treaty provisions. I'm not going to go into that. We just don't have time. It could be, many of these topics could be a webinar all unto themselves. I get questions occasionally about, what happens when a US company does business in a foreign country, and that's really beyond the scope of this conversation. But just so that everybody can hear the words, the US entity has what we call Subpart F income. They got to pay taxes on that income if it's not repatriated back to the US. US income taxes on corporations, right now, the maximum federal rate is 21%. It's your net income is taxed at 21% after all your expenses. That number, it's just flat. Whether you make $1 or $100 million, the rate's the same. President Biden campaigned on a promise that he was going to raise that rate to 28%. There's a bill that was currently passed by the Senate a couple of days ago, expected to be passed by the House and then signed into law by the president. That does not have this provision. We're going to wait and see if he's got the political pull to get that rate raised and whether or not it will go to 28%. But right now, the flat federal tax, 21%. In addition to filing taxes at a federal level, business entities have to file at a state level as well. So if you form, wherever you're formed, that gives you nexus with that state. So you must file a tax return wherever you're formed, and different states have different rates. Rates can go anywhere from 1% to 12% of your typically net income. And any state that you do business in, you have to file a tax return, no matter where you incorporated. So if you formed your corporation in Delaware, and you want to do business in New York, you hire employees in New York, you have a warehouse in New York, then you make sales in New York, then that business is going to file a tax return in Delaware and New York. And you get to apportion your income based on different factors. Different states may have different apportionment factors. Most states use sales. So you'll wind up filing a tax return in 2 states in that example. Certain states do have tax credits or other benefits for bringing jobs to that state. It's usually determined on a case-by-case basis, usually having to do with bringing manufacturing jobs into the state, and usually into economically disadvantaged areas. So when you're an automobile company and you want to bring in an automobile manufacturing plant into the US, many states will offer you all kinds of incentives with either low costs for energy or low costs for taxes, for real estate taxes, or maybe even some income tax credits as well. At the individual level, you have to file a tax return in the US for income earned in the US. And the United States, unlike many countries in the world, the US government does not prepare your personal tax return for you. You have to engage, you either have to prepare it and file it yourself or engage a professional to prepare your return. It's reasonably complicated to prepare a US return, and most people who earn a significant amount of money from a business do not prepare their own return. A non-resident, non-US citizen, you work abroad for a US company and the US company pays you, a wages or a non-employee compensation, you do not have to file a tax return in the US for that. However, if a non-US citizen works in the US, then yes, you'll have to file a tax return in the US. And usually you'll get credit in your home country for taxes paid to the US so that you're not taxed on the same income twice. For individuals, right now, the maximum federal tax rate is 37%. Unlike the corporate rate, which is 21%, the corporate rate's a flat 21%. The individual income tax rate is a graduated tax. It starts off significantly low at 0% and works its way up to 37%, depending upon whether or not you're married or single or head of household. Again, President Biden, Democrats campaigned on a promise to raise the tax rate, the maximum individual rate, from 37 to 39%. So anywhere in the US, you file a federal tax return, and then again, depending upon where you're domiciled, and we refer to this as the teddy bear test. Where do you keep your teddy bear at night is where you're usually domiciled. So you may work in New York City, but live in New Jersey, and you could wind up paying taxes in both states. And again, you'll get a credit on one state for taxes paid to the other, so you don't wind up paying taxes twice. You just have to file 2 tax returns. So the most popular question I get by far is, well, how do I keep my foreign entity or my foreign client outside of the IRS's radar? I don't want my client or my client's company to show up on the US taxing system. And the easiest way to do that is set up a blocker entity. Usually it's a corporation, although it can be an LLC that elects to be taxed as a corporation. It could be a trust, but that's much more complicated to set up. And that eliminates the need for your foreign entity to file a tax return in the US. So your foreign entity owns a US corporation, and then that US corporation does its business in the US. The US corporation files a tax return, and your client never has to file in the US. And another popular question I get is, well, how do I eliminate any possible estate tax issues for an individual? And again, it's the same type of strategy. You create a US entity, corporation that owns your US assets, either stocks or real estate, and then you can eliminate the obligation for the individual to pay the estate tax. As well as if you have a US entity, certain US entities are eligible for certain federal or state credit, loan, or grant programs. These are a couple of the different grant programs and loan programs that were just, well, 3 of them were created recently. The domestic production credit has been around for a very long time now. In order to do business in the US, you'll need to get an employer identification number. What is it? It's a unique number assigned by the federal government. So even though your entity is created at the state level, this EIN, the employer identification number, is issued at the federal level. You need it. Every tax return filed in the US has your federal employer identification number. Banks will not open up a bank account without one. There are 2 ways to get an EIN, an employer identification number. The easy way, you have what's called a responsible person. They don't really have any legal obligations. They don't have They don't have any filing obligations, but they're called a responsible person. And if that responsible person has a social security number, then it's very easy to get an employer identification number for your corporation. It'll take about 10 minutes. You can file a form online and apply for the EIN, and it's usually issued in just a couple of minutes. Then there's the long way. If you don't have a responsible person with a social security number, you've got to file the form W-7, and with that W-7, they will ask for all kinds of original documents, including your passport. You have to send your original of your passport or a verified copy of it. Submit it to the IRS. They are months behind in opening up their mail. It could take, our experience has shown us that it takes anywhere from 2 to 6 months to get the employer identification number. It is annoying, it is time consuming. There's no guarantee that the IRS will not lose your letter the first time. They may get it, open it, ask questions, ask for more information, and running through that whole process just takes a lot of time. So in the US, the defining term for whether or not you've got to file a tax return is nexus. Nexus for income taxes is different than nexus from sales taxes. Nexus for income taxes, and it's different at the federal level than it is at the state's level. So the federal level, if a foreign entity has effectively connected income to the US and has a permanent establishment, a fixed place of business, employees, inventory, fixed assets in the US for more than 180 days, then for federal purposes, you have effectively connected income and you have to file a tax return. At the state level, it's a much different definition. The state level for nexus, you have to have a physical presence. And that typically involves having inventory in a state, fixed assets in the state, or employees. So again, a question I get with some frequency is, I sell through Amazon. I ship my goods to Amazon. Amazon holds them in a warehouse. I'm not quite sure what state the warehouse is in, and they move my inventory around, but the inventory is my inventory. Having inventory in a state gives you nexus. And this is a troubling event for many people who are selling through these online retailers, is all of a sudden they have nexus with these states. They have no employees here. They have no fixed assets, but they're storing inventory in the state. And that's enough to give you nexus, and the state can come after you and make you file an income tax return and apportion part of your income. As the states are hungrier and hungrier for money, it is easy to go after these types of entities because they're usually out of state and they don't vote. So California right now has a very big push, for example, to tax people who store their inventory in California and sell it through Amazon. For sales taxes, nexus is a much different definition. Recently in 2018, we had a Supreme Court decision that said that if you ship your goods into a state, whether or not you have a physical presence there, whether you keep inventory there, whether or not you have fixed assets there, whether or not you have employees there, just the simple process of shipping goods into the state for sale gives you nexus for sales tax purposes. And I'm going to go into that in a little bit more detail a little later in this presentation, but this was a very big change in tax policy in the US. Transfer pricing is probably a concept that many of you are familiar with. It's similar in the US as it is in many other countries across the planet. Do you need a transfer pricing study? You're not legally required to have one. Well, I shouldn't say you're not legally required to have it in all instances. Once you hit a certain amount of transactions, if you don't have it and there is a transfer pricing adjustment, then the penalty could be 40% of the adjustment. If there's no adjustment, there's no penalty, but you run that risk if you don't have a written transfer pricing document. You also may wind up with double taxation because typically the IRS Internal Revenue Service adjustments are not recognized by your home country. So you may not wind up with the benefit if the IRS comes up with a larger amount of cost that should be allocated to the US. There are different types of transfer pricing options: transaction comparables, comparable profits, profit split methods, as well as you can apply for an advanced pricing agreement with the IRS. You can actually get them to bless your transfer pricing arrangements before you implement them. But again, this topic could be a webinar all by itself. Some people attending this webinar asked the question, what's the best way to capitalize my US entity? And there are really effectively two ways. You could either lend money into the US entity, or you can capitalize it with equity, whether it's paid in capital or cash for shares. Once it is in as equity, it's more difficult to get out. Requires a little bit more planning, a little bit more legal work to recover your equity. Loans, on the other hand, are very simple to get out. You lend the corporation money, the corporation can repay its loan. There are certain requirements. If it's going to be a loan, it has to look like a loan. It has to pay interest. It has to be evidenced by a note. So it requires a little bit of work to set up, but it's much easier to get money out as a loan than it is to get money out as equity. Banking, finance issues. You come to the US, you got your employer identification number, you created your corporation, and now you need a bank. Banks in the US are subject to various different laws, the Bank Secrecy Act, the Patriot Act, to name two of the big ones. Those require the bank to know their customer, the KYC rules. Probably similar to many countries now across the world. The US has been imposing its will on banks wherever it can to make the banks know their customers as well. So you probably run up against some of these questions and types of processes before. It is very difficult for a US bank to really know who their customer is when they're located outside of the country. I always tell people the easiest way to set up a bank account and get a line of credit is to deal with a local bank that has branches in the US. So very often the big banks will have branches in the host country. It's easier if you have a relationship with a big bank that's got a US branch. Otherwise, you can open up a bank account in the US relatively easily with a little bit of difficulty as a foreign-owned corporation. However, getting a line of credit becomes much more difficult. Banks are very hesitant to lend to US entities that are foreign-owned unless they're extraordinarily credit-worthy. So in the US, we have sales taxes. We do not have a value-added tax. There's no VAT tax in the US. The big difference here, sales taxes are a consumption tax levied against the ultimate consumer of a product or service. It is not levied along the supply chain. It's only collected from the ultimate consumer, whether it's an individual or a business. Sales taxes are levied at the state level. There is no federal sales tax. And sales tax liability usually is incurred when title to the goods passes. and where title passes. So if you ship goods from New York to, again, I don't want to pick on New Jersey all the time, but I will, to New Jersey, then the sales tax would be collected at New Jersey. If your customer comes into New York from New Jersey to pick up the goods in New York, then they pay New York sales tax. And sales taxes vary from state to state. They vary from a low, Colorado is 2.9% currently. Tennessee is at a high 9.55%. There could be city sales taxes as well. And they could push that rate to over 10%. For example, Seattle and Washington, when you add those city taxes to the state taxes, the sales tax is over 10%. The sales tax rules also vary from state to state. There is no universal accepted standard as to what is subject to sales tax or even how it's taxed. One of the great examples to show people how strange it is in New York, if you go to the food store and you buy a loaf of bread and you buy a pound of sliced ham and you buy a jar of mustard, none of those items are subject to sales tax. You go to the same store and you buy a ham sandwich with mustard, it's subject to sales tax. I didn't say it makes sense. I didn't say it's logical. You know, every state has its own rules, and ham sandwiches may not be subject to sales tax in Iowa. You know, Iowa may have a completely different set of rules. But property subject for resale and intangibles usually not subject to sales tax. So if you're in business and you buy a component of a machine, you buy a light bulb that's going into a machine and you're going to sell the machine is subject to sales tax. Your purchase of the light bulb is not. However, if you just bought a light bulb to plug it into a light fixture, that would be subject to sales tax. Sorry about that. Some states do have a universal sales tax. Most do not. There are companies out there that are internet-based companies that help clients register and file sales tax all across the country. Avalara is one. It's gotten to the point where it's so complicated and so voluminous that these sales tax companies are like our payroll companies. They are very effective and very cost effective for complying with the sales tax rules. The Wayfair decision 2018, the Supreme Court decides that you don't need the physical presence to be subject to sales tax in a state. Every state is now free to determine their own rules as to when you are required to collect sales tax. So all of the states have been scrambling to create these rules. It's a very popular thing. They can collect sales tax, again, from people who don't vote and corporations not physically located in their state. It usually runs something like this. You have to have $100,000 of transactions. It could be as high as 500,000. Some states have a minimum number of transactions. Typically, it's around 200. Some states, it's taxed at the first transactions. And again, Avalara is a company that can help you set this up. The potential problems with the Wayfair decision is that this now much looser definition of nexus, of when you have to file a return, could start to be applied to income tax returns as well. Right now, there's a public law 86-272 prohibits that. But the states are constantly trying to overturn that law to apply these provisions to income taxes as well as sales tax, but that's not the way it is right now. Employee considerations, employment considerations. In the US, we have a concept called employment at will. Michael will go into that in more detail probably than I will. But it basically means employees are hired and fired at will. You can't discriminate based on race, religion, creed, sexual orientation, or disability. But employment at will could be restricted in cases of either union employees or employees with an employment contract. So employment contracts can cut both ways. They can guarantee that your employee can't leave, but they also set up an obligation for you to keep your employee employed, and you may not be able to fire them as easily if they have an employment contract. What do you need to work in the US? You either have to be a US citizen, you have to be a green card holder, or you have to be on a work visa. And there are several different kinds of work visas. I'm just going to quickly describe one. There's an L1 visa. It's used to enter the US for a period of time. Usually it's a short period of time, anywhere from 3 to 5 years, depending upon the visa. And then you can extend it. So we have a client that is an international airline. And what they do is they are based out of the US, but they post employees here under L1 visa program. So they take their own employees, and that's one of the provisions. You have to have worked for the parent company. They can then bring the employee into the US for a period of time. For them, typically it's 3 years, and they'll do this under the L1 visa, and they'll extend it. If the employee is here less than 6 months, usually not subject to US income tax. If they're here more than 6 months, then they have to file US income tax returns. Many people try very hard not to classify somebody as an employee. They want to keep them as an independent contractor. The IRS has a 20-part test to see if someone is actually an employee or an independent contractor. It's getting much harder to classify them as independent contractor. Failing any one part of the test doesn't automatically make someone an employee. It's what we call a preponderance of evidence test. If you start to fail multiple parts, then the chances are that the person is an employee. Failing any one part does not automatically make them an employee. And if they're an independent contractor, then the filing requirements for the company are much easier. You just send a 1099. You do not have to give them all the payroll forms, and you don't have to pay payroll taxes for the employee. Payroll taxes, insurance that are either legally required or customary in the US. Social Security tax is required. It's a pretty expensive number. It is 7.62% of 7.65% of the employee's wages, and the employee pays the 7+%, and the employer pays 7% as well. So that's a pretty expensive payroll tax, as well as you have to maintain unemployment insurance both at the federal and state level, disability insurance, workman's comp insurance, and file payroll tax returns for the employees. And there are payroll companies that will help you file all of these forms and calculate the taxes. And they're almost universally used in the US. There are very few people who still do their own payroll tax returns. Typical other considerations for employees in the US: paid time off. Salaried employees or hourly employees usually get a minimum of 2 weeks off. It could be as high as 4 weeks, but it's customary for somewhere between 2 to 4 weeks. A typical work week in the US is daily work is 9 to 5, it could be 9 to 6. So it's somewhere between 7 to 8 hours a day, 5 days a week. Some states now have mandatory sick days. New York has mandatory sick days. I believe you have to give 5 sick days per year. You may have to negotiate with your unions. If you have a union shop, there are minimum wages to be paid to the employees. Those vary. There is a federal minimum wage. It's relatively low, a little over $7 an hour. The bill that was just passed a couple of days ago tried to raise it to $15 an hour. They had to take that part out of the bill in order to get it passed. So most states have minimum wages that are greater than the federal number. Tariffs, I'm just going to mention that there are two kinds of tariffs. There are fixed dollar amount and fixed percentage amounts. Not all goods are subject to tariffs. Services are usually not subject to tariffs. But again, this could be its own webinar all by itself. Another question I get fairly frequently is owning real property. Either your client or the people listening on this webinar, they want to invest in U.S. real estate, but they don't want to be on the tax filing requirements of the U.S. So in order to avoid that, they usually set up a blocker corporation to own the real estate. The entity that owns the real estate will have to pay taxes. If the real estate, if it's rental property, then whatever the net income is, the entity will have to pay annual taxes on the net income and taxes on any gain on sale. If it is investment property, there is an ability in the U.S. to sell the property and buy another investment property and defer the gain. That's Section 1031. And again, the Democrats have campaigned on the promise that they were going to eliminate that section, but right now it is still in effect. So if you own an apartment building or even a single unit, a condominium that you rent out that you don't use personally, and you own it, and then in a year or 2 or 3 or 10 or 20, you want to sell it and go buy a shopping mall or any other type of investment property, you could take the entire proceeds and defer the tax until you ultimately sell your last piece of property and don't replace it. For personal property where there's no rental income, it's only the gain that would be subject to tax. You have to be careful how many days you spend in the U.S. so that you don't become a resident for tax purposes. It's usually less than 180 days a year in the U.S. And that's the end of my part of this presentation. And I hope I gave you enough information to understand how to do business in the U.S. Hopefully I didn't scare anybody off. I appreciate the opportunity to talk and for MGI to allow me to present this webinar. There'll be a question and answer period at the end. Michael Einbinder, a great attorney, is going to take the next part. And Paul, I'm going to turn everything back over to you.
Thanks, Robert. That was a massive information that will be very relevant to anyone looking to do business in the US. So thank you for that. And just to reiterate what Robert said, if you have any questions about some of the specific points, do pop them in the chat box and we'll come back to them later on. But for now, I'd like to introduce Michael Einbinder, who was one of the founders of Einbinder and Dunn, who are a prestigious New York City boutique law firm. Michael has over 30 years of experience in the legal community, covering areas such as corporate law, franchising, real estate, and dispute resolution, amongst other things. But I think what's been made really clear by Robert and talking to Michael is that his real value is his unique ability to give practical advice, which is what you need when you're trying to set up in another country. So he's an invaluable part of the team if you're looking to do business in the US. So over to you, Michael. Thank you.
Give me a moment, please. I'm just going to try and remember how to do this. There we go. Good morning and afternoon to everybody. Robert, that was terrific, very, very informative, and as a lawyer, very interesting for a lot of information for my clients that I can pass on. So thank you very much.
Michael, sorry, just to mention, your translation isn't coming up.
Oh, my. It should have.
If
So
you
let me-
just stop sharing.
yeah, I'll do that just for a moment. So I've got, I'm sorry, give me one moment, I'm sorry.
If you go to slideshow and then go to the far right, it should say, it should have a checkbox there for you to mark.
And always use subtitles. It's marked. Try that.
Okay, do you want to try it again?
I will.
Thank you, Michael.
All right. Does this work? Is my translation coming up now? Here it is. Thank you. Thank you. Good morning, everyone. My name is Michael Einbinder, and as Paul and Robert have said, we are a law firm in New York City and represent small and medium-sized businesses, pretty much all aspects of their operations. Part of our practice is representing clients in transactional matters, in setting up business entities and so on, and some of it is in dispute resolution. As Paul said, I represent clients in litigation and lawsuits all the time. I'm a trial lawyer. I'm also an arbitrator for the American Arbitration Association. Part of what I'm going to tell you today is really informed by the part of my practice that relates to solving problems for clients when they aren't complying with the legal rules that govern their industries. And so I tend to err on the side of caution for clients and try to tell people what issues may come up so that they can avoid problems down the line. Starting with a lot of what Robert said about forming entities in the States, I just want to add to that the primary reason we set up corporations, other than tax reasons, corporations and limited liability companies, is to create a liability shield for the owners of the companies. And corporations and limited liability companies do that, whereas partnerships may not. The individual owners of partners may be responsible for the debts and obligations of the partnerships and joint ventures. And so there's a concern when you're doing business as to whether or not you are protected against claims that are made against your entities. And so we always recommend to the formation of corporations and limited liability companies to protect assets and to do business. Obviously, there are tax consequences to all of this, and Robert explained that in great detail, and I think you should understand that as well. As Robert said, state laws differ in the United States. Forming an entity, forming an LLC, forming a corporation is always going to be based on the state law, the place where you decide to form that corporation. The state laws differ from state to state, and the tax issues that Robert went through differ from state to state as well. And so you really do want to make sure that you're forming your entity in the right place for the business that you're operating in. My recommendation to clients is generally either to form in the state where they're operating or where most of their operations are, or to form in one of the more tax and corporate friendly states like Delaware or Nevada. And the reason the tax issues that Robert talked about are obviously important, and I often simply refer my clients to accountants to get information on where the best place to form is. But there are other issues that relate to where you form. New York State, for example, where I practice law, but we also practice nationwide, but where my office is located, has a business law regime that is not necessarily friendly to all owners, all major shareholders. There are minority shareholder rights in New York State that don't exist in other states. Delaware is the most corporate-friendly state, and that's one of the reasons, other than the tax considerations, why people form their entities in Delaware or Nevada for the same purpose. The control of the company rests in the hands of the majority, significantly more so than it does in a state like New York or New Jersey, where I also practice. The issues about whether or not minority shareholders have rights are something that's important for corporations forming to consider. Does your minority shareholder have a right to take legal action, or are those rights strong? And can the majority owners of the entity control the business of it in a manner that they think is right and in accordance with their business judgment? And so for those purposes, we often recommend Delaware. Governance of corporations and businesses is critically important in the States. Now, if you're a sole shareholder, if a corporate entity is owned by one European entity, and that's all, and the only shareholder of that entity is the home country company, then these issues are less important. But if there are shareholders or other owners, members, as there are in limited liability companies, then there is a concern about whether or not you're handling your corporate governance, your documentation in a manner that's consistent with the laws of the state where you are operating. We recommend shareholders agreements and operating agreements for virtually every business that we work with. Those documents control how votes are taken, how major decisions are made, how hiring and firing is done, how large transactions can take place.
Hi, Michael. Sorry to interrupt there. Would it be possible for you to speak just a bit slower so the translation works better?
I'm sorry.
Thank you, Michael.
So we do recommend that companies make a decision early on about whether or not they want to create these kinds of documents to operate their business. And we think it's critical, particularly when there's more than one owner of the business. Bylaws are created for corporations. Operating agreements typically cover the way businesses are operated when they're operated as LLCs. The board of directors of the company, when you form as a corporation, those boards of directors elect officers, and all of these things have to be done in accordance with the rules set up by the entity in order to avoid liability issues. And what I see typically when people are not forming their businesses the right way is that issues arise. Problems with shareholders, disputes between shareholders. In my dispute resolution practice, when I'm practicing as an arbitrator in cases, I frequently see situations where one shareholder is seeking a recovery against a controlling shareholder for violating whatever rules apply to that business, either through the corporate entity documents or through the state law. And so what you want to do is you want to set up those documents and control your business in a way that avoids those kinds of concerns and possible liabilities. You may come to the US either by setting up a new entity, and I just described in some detail how those new entities should be established, and of course Robert dealt with a lot of those issues, or you may acquire an existing business. But where you acquire an existing business, you create a subsidiary of your foreign company in the United States. There are a number of relevant laws, both state and federal, that apply to these instances or these kinds of transactions. And as Robert said several times during the course of his presentation, you could do a seminar on any of these. What I tell a group like this is, depending on what the nature of your business is, will govern the legal issues that apply. So there's not enough time to talk about Securities and Exchange Commission rules or anti-takeover rules on a state level, but if you tell me and contact me and ask me questions about those rules as they pertain to your specific business, more information is available. I wanted to give some information on federal regulations concerning industries that are actually regulated when there's a foreign investment or control. Some of those industries are security and defense industries, nuclear power industries, maritime industries, airlines, media and banking. And in my review of the rules concerning these types of businesses, what I find is some of these types of businesses simply are not allowed to be owned by foreign investments. Some of them are only allowed to be owned up to a certain percentage. So again, a course could be taught or a presentation could be made on all of this, but it depends on the industry that you're involved in. And so if you're going to become involved in a media business and you're going to acquire a media business as a foreign entity, you're limited to 25%. Banking is going to be substantially different, and the regulations and the disclosures for banking are going to be completely different. And that's only at the federal level. So when you start talking about state restrictions and laws, you add a whole level of complexity to the transaction, and each one of these things has to be looked at on a case-by-case basis. I wanted to touch on products liability and the Consumer Protection Safety Acts. Federal law controls a number of product categories, children's toys, jewelry, and other things. And so depending on what you're either importing into this country or setting up a business to sell in this country, you may be governed at a federal level by the Consumer Protection Safety Administration or by any of the other governmental organizations that control the distribution and sale of products here. You have to be careful about that. And products liability is a category of law in the states that can be very complex. If you are involved in selling a product that causes some kind of an injury, there are state cases that are, where companies are held liable for significant amounts of money when they sell dangerous products in the states. And so you need to comply with these regulations in order to be more comfortable about the kind of products that you sell here. Robert touched on the state level regulatory scheme as it relates to setting up your entities, and I did as well. But there's also a requirement, for example, if you set up your company and you're doing business in New York and you want to do business in California, you may have to get authorization to do business in California as well. And it's going to depend on how much business you do there. If you're regularly selling products there or you have a salesperson there, you may simply need to file a form that allows you to do business in that state. And that, of course, is going to depend on the type of business that you're involved in. Robert also spoke about leases or about owning real property or leasing real property. Obviously, these are document-heavy transactions. Lease transactions, warehouse lease transactions, or office lease transactions can be fairly complex documents. We do a lot of real estate work, and the leases that we see range anywhere from 25 to 150 pages, depending on the nature of the landlord and the type of operation they have. For example, when we deal with clients that are mall-based in the United States, some of the larger landlords have exceptionally complicated leases, which provide for not only a monthly lease payment, but also a percentage rent based on the sales of goods in your stores. If you're doing a retail lease, they also frequently require you, almost always require you to pay taxes and other local requirements for the operation of the business, taxes, water and sewer charges for the operation of your business as well, either directly to the taxing entities or to the landlord as a pass-through to those taxing entities that require payments. And so you have to be careful when you enter into leases that you understand all of your lease obligations and not just the base rent. A lot of the rules that I'm talking about are state-specific as well as federal. And so again, when you set up business in the US, you have to really give consideration to the state where you're operating and make sure that you are following all of the rules and regulations of the state and local laws. Robert touched on labor laws in the US. I will as well for a moment. There are rights to form unions. There are regulations concerning unions you have to be careful about. Title VII is the non-discrimination rules that Robert referred to, no discrimination on the basis of race, color, creed, religion, orientation, and other things. And so disabilities, you really have to be careful about the way you set up your business and the way you hire. There are major lawsuits over discrimination against large and small companies alike. There are many cases against businesses for not hiring people who are disabled. There are a number of lawsuits that I've seen from retail clients of mine for not following the Americans with Disabilities Act, so that if your premises, for example, are not accessible to people using wheelchairs, you're frequently going to get sued for that lack of accessibility, and those cases can be very expensive to defend and pay out on. Robert also spoke something in some detail about immigration issues. I'm going to leave it at what Robert said. It was much more informative than I can give you information about. The best I can do on immigration is tell you that there are rules you have to follow, and there are immigration lawyers that can help you follow them. We don't do any work in that area, but we work with immigration counsel to help our clients understand what the rules and regulations are. The United States has, I found out recently from a client of mine from Canada that that non-competition agreements are not typically enforceable or even applicable in Canada. Non-competition provisions of agreements in the States are. Oftentimes, companies, when hiring employees, prohibit them from moving from place to place if they're in the same line of business, whether it's an accountant or a freight broker or an accountant, lawyers, anybody that they can try to control, employers will try to control. And the problem here is, the benefit here for a company coming to the US is that you can put non-competition clauses into your agreements to protect the information that you give to employees and to protect your customers from being taken by that employee if they leave. The opposite is also true. So if you hire someone from a competitive company, we represent a client in the insurance industry that hired about 25 people from another insurance company, is being sued for participating in the violation of that employee's non-competition agreement. So you have to be very careful about that. When you set up a business here and you do want to have non-competition provisions in your agreements, you should be very careful about how they're drafted. If they're drafted too broadly, they're not going to be enforceable. They have to be very specific and detailed about how you're going to how you're going to try and stop people from competing against you if they leave your business. So this is an issue that comes up quite frequently in businesses in the US. Robert dealt with termination of employment. The United States is an employment at will. All the jurisdictions in the US are employment at will, meaning that you can fire anyone for any cause or no cause, limited only by not discriminating against your employees on the basis of the Title VII non-discrimination provisions I spoke about before. There are employment contracts, of course, and employment contracts can last for a period of time. You can terminate someone for clause under an employment agreement, but you may be liable to those former employees for payment down the line for the money that they were going to earn during the course of their employment with the company. But the United States is an employment at will country, and the states follow those rules, and you can fire anyone for any reason that's non-discriminatory. I want to talk a little bit about intellectual property. The United States has, on a federal level, copyright protection and trademark and patent protection. The Copyright Office requires registration of your copyrighted material. That could be written material or even designs. We have one client who's a designer and manufacturer of wedding dresses. She files her designs with the Copyright Office. The copyright law affords protections for copyright owners. It allows for lawsuits to be commenced. It allows for specific liability as to copyrighted materials. There's minimum liability, even if you can't prove a financial loss because of the copyright violation, but it's critical to protect your copyrights through the Copyright Office, if at all possible, and to file those documents that are necessary to register your copyright. Patent and Trademark Office in the US is also registers both of those types of intellectual properties. We do much more work in the trademark sphere. Registering a trademark gives you significant protection against other businesses that operate using your trademark. Again, federal lawsuits are in the trademark arena are very frequent. Companies can sue businesses that operate and use someone else's trademark or something that's confusingly similar to the trademark for a trademark violation, and there can be significant liability. So if you're coming to the US and you have a trademark name that is protected in the European Union, for example, you still are going to have to protect that trademark here. You're still going to have to make sure that you can use that trademark here. If there are other businesses in the US that use similar trademarks, they may take legal action against you for using a trademark where your trademark is, or your business name or business operations use a name or a trademark, trade name that's substantially similar or confusingly similar to theirs. So you have to make sure that you're using the right names in the operation of your businesses. Trademarks, rather trade secret issues come up a lot in the intellectual property arena. You need to contract to protect your trade secrets with your employees, with your vendors, with other people that you do business with, so that the information that relates to your proprietary trade secrets and confidential information is protected against use by other people. There's a recently legislated federal law on the trademark secrets, that provides fairly significant protection against the use of your trade secrets by people who infringe on them. You should do everything you possibly can to protect those trade secrets. State law also involves, there's a lot of state laws differing from state to state, as it is in the United States. Frequently, there are state laws that are diverse. And one of the problems here is that you have to make sure that you follow and mandate that your company uses, understands the state laws that affect your trade secrets. But there are lawsuits under trade secret provisions, state by state as well. And so you need to protect yourself with respect to your trade secrets. One of the things that we do a lot in litigation and luckily,
Michael, I hate to do this to you, but we're running overtime already.
I know. I can stop now. I can just I also have the slides that I think Maxine will send out to everybody. I was going to talk briefly about protecting your trademarks, which I think is critical. Aside from simply the matter of filing and registering those trademarks, you really have to protect it if someone uses it improperly. If you don't protect your trademark, you may lose the right to protect it. I guess I'm out of time. I was also going to talk about franchise legal issues. We do a lot of work in that arena. If you need some information on that, there's a fair amount of information on my website about the franchise laws in the States. So again, I thank you all for your time today. Robert, I thank you for inviting me. Paul and Maxine and Nancy, thank you very much.
Thanks, Michael. I mean, I'm sure everyone will recognise that they've been given a in-depth introduction to doing business in the US this afternoon from both of you gents, and it's become quite clear the choice of business structures and where you set up. The notion that probably you set up where you're doing most business or where there's the best tax advantage, but whether to set up as a business has come up in a couple of questions. If we can just refer to those. On the chat box, Zoran's asked, is it possible to do business via a tax representative? So he has a company in Serbia that wants to sell some services via a tax representative without a legal entity in the US. Can that work?
Yes, you can have a foreign branch. First of all, you could sell directly as a foreign branch,
Yep.
as well as you could sell to an unrelated US entity and let them resell your product.
Okay, and the same would apply for a service?
Same would apply for a service.
Okay.
So for income tax purposes, it's the permanent establishment of a presence in the US would obligate you to file tax returns. And if you don't have employees here, you don't have a permanent place of business, then you don't have to file a tax return. However, for sales taxes, you may wind up having to file sales tax returns even though you don't file income tax returns.
Okay. Robert, that leads into the second question. where one of the attendees has made reference to being a software development company that has clients in the US. So if we open an entity in the USA, what benefits do the customers get from having that local business to deal with? And also, is there a provision for a virtual office so there's no one actually working in the US, just selling from a foreign territory into the US?
So I'm going to share my screen, I just realized, because then the translation will show up. The question being, if they sell software into the US, either virtually or through an actual office.
Yeah, so what's the advantages of having a physical presence in the US, and what is the position if they just sell remotely from a foreign territory?
Well, the advantage of, this is a business decision, the advantage of having a physical presence in the US is that you can have employees here who can actually make sales calls. You can open up bank accounts in the US, your customers can pay easily, make payments easily to you in US dollars, and still the predominant way of transferring money in the US is with checks. The rest of the world is usually electronically. So they have a physical address to mail a check to. You could have a native US person promoting your product, going to sales shows, or you may even need some software development or various services that are typical to your business in the US. In that case, you would open up a US corporation with employees. But if you could strictly sell your product online and you don't need to have somebody in the US and they can make payments by credit cards to a foreign entity, then there's no reason to open up a US entity. However, software sales in the US usually go something like this. If it's packaged software, you buy Microsoft Word and you're not customizing the software. Packaged software, like buying Microsoft Word, usually is subject to sales tax. However, if you're in the business of creating customized software, someone engages you to write a software product to control their business and deal with the inventory, and it's not a product that you sell to everybody. This is built one of a kind. Then that usually is not subject to sales tax.
That's really useful. Thank you. A couple other questions that I was wondering, where you made reference to the importance of having a responsible person for when you're getting set up in the States. I mean, how do you get around that problem if you don't actually, or what does a responsible person need to be? Is that someone, as a professional contact, can act as a responsible person, or is it a long-time friend, or what does it mean?
Many times people have a relative in the US who will act as their responsible person to get the employer identification number, or a friend, or it could even be an employee if you hire. I have one client who's coming in from Canada, wants to set up a business here. They hired a key salesperson, an administrative person in the US, and that person acted as the responsible person to get the EIN. If you don't have that, again, you got to file a W-7. Someone's going to have to submit a copy or a certified copy or original of their passport, along with various other documentation. Wait for the IRS to open the mail, ask questions, and respond. And that whole process is a 2 to 6 month process.
So you really need someone through historic links one way or another to shortcut it, don't you?
If you have somebody, it makes it much easier. You can get an EIN in 10 minutes that way.
Yeah, okay. And the notion of the nexus for a tax presence, can you do anything to manage that to your better advantage, or are you just stuck with the facts of the case?
You're stuck with the facts of the case. If you have employees here, or physical place, or inventory, or maybe you're in the machine repair business and you keep a stock of inventory in the US so that you could send out the parts quickly and easily to your customers, then you have a nexus with the US. You have to file a tax return in the US. And we have to determine whether or not it makes sense to open up a blocker corporation or to file as a branch.
Okay, thank you. And again, branches are coming up a lot. Sanjeev has asked if an Indian company wishes to set up a branch in the US, does the law permit registration of a branch of a foreign company, which I think you've said it does?
Well, again, let's define that clearly. So an Indian company can open up a US subsidiary, a US corporation as a subsidiary relatively easily.
But could it set up a branch without actually having a corporate structure?
I don't think there is a lawyer in the world that would tell you to just send your employees here as a foreign entity and not create a corporation.
Okay.
I can answer that also. I can tell you absolutely don't do that. There are significant potential liability issues for that.
Okay.
You're subjecting your home entity to liability for claims that are made against your branch office. It's not a good idea. And then the control issues and protecting assets and so on really are diminished. So I recommend to everyone who asks the question that they should set up a separate entity.
Okay, that's really clear. Thank you. I hope that's useful, Sanjeev, because if you've got that local company, you can then get a bank account as well more easily, can't you?
Yes.
Yeah. And we've got a question here. What's the best way to own real estate in the USA for a foreigner, for a non-resident?
Usually through a blocker corporation.
Yeah. Yeah, you made that clear earlier. Well, hang on, I'm just going back to chat because there's a couple of other things in there. So there's a question here about payrolls from Andy Arias. What about split payrolls where part of it's paid to someone based in the US and another part is paid in Mexico? Does he have to file for taxes for 100% of the income or just the US part in the US?
That's going to depend upon the individual who's receiving the payroll. If he's a US citizen, he's taxed on his worldwide income.
Yeah.
If he is a non-resident, non-US citizen who doesn't work in the US but is just paid for out of the US company, then he wouldn't have to file a tax return in the US. He has no effectively connected income to the US. And if he is a non-citizen who's here on a visa, then he would be taxed on his US income and not his foreign income.
Okay. Well, if any of the questions have not been put forward quite correctly by me, I apologize. And if any of the answers need expanding upon, you know where to find Robert at the end of the day. Maxine has put the doing business in the US guide in the chat box. If anyone wants to click on that, you'll see all the details there. And we have run a little bit over, but the audience has stuck with us this afternoon. So I think that highlights what a compelling subject this is for everybody. And on behalf of MGI and CPAAI, I want to thank both of you for a really engaging presentation this afternoon. As I said, everybody's stuck with us for a slightly longer presentation, which means they want this information. So thank you both. Anything you'd like to add to that, Maxine?
No, just thank you so much. And thank you, Paul, for taking the time out of your day as well to join in today and help with the fielding of questions. That's super useful. We have recorded today's webinar, so we will be sharing that with everybody. As Paul mentioned, there is a doing business guide in the chat that you can download, which is a great short brochure PDF with information in there. We also have the presentation files that we can share with you as well. And obviously, Robert is available, as is Michael, to follow up on any questions that you have. So really great. Thank you for joining us. We've got clients and we've got members on today's call. So if there are any members that would like to also do a webinar of this nature for your local market, and we can help you with that. We can also produce doing business guides for you. If there's a certain jurisdiction that you have clients invested in or doing business and would benefit from a similar webinar, then please get in touch. Other than that, I think that brings us to an end today. Thank you for sticking with us. And again, thank you so much, Robert, and to Michael for your time and your contribution today. Thanks a lot, everybody.
Thank you for the opportunity
Thanks.
Thanks, Robert. Thanks, Michael. We look forward to seeing you in New York when we're allowed to come and play again.
That would be great.